What's up, guys? Welcome back to another episode of Behind the Facade. I am your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. What's up, guys? Welcome back to another episode. And as you can probably hear, I have a bit of a cold. Just trying to clear these sinuses. I picked up a cold over the weekend, St. Patrick's weekend. And so that is the reason why this week's podcast is a little bit late. I have this cold and I didn't want to try to speak while I was all bunged up. As I'm recording this, it is Wednesday and we just spent a couple of days down in Cork. We were down at the Photo Wildlife Park. And as you can probably tell, I do enjoy getting around, traveling a bit, but it's not always smooth. And you know from, if you've been following the journey for the last couple of episodes, you will have seen that I was in Rome in January. And I came back and I ended up making an episode about tenacity after all of the drama that ensued when my daughter's passport was out of date just the night. We discovered it just the night before the airport. And so that was what I talked about after that event. But there was something else that happened on that trip that really I wanted to kind of bring it up here. And it's something that I think every investor needs to bear in mind. And what I'm going to do is I'm going to set the scene for you. You see, we arrived in Rome and, we had the drama the day before. So we're chilling out and we were staying in the very aptly named Pantheon Hotel. Now, those of you who know anything about Rome, you will know about this old building called the Pantheon. And our hotel was literally about 50 meters away from the Pantheon. So really good location right in the old part of Rome. And, if you're not familiar with Rome and what the Pantheon is, it's not to be confused with the Parthenon, which is in Athens, which is this old ruin up on the hill. The Pantheon is this old temple that sits right smack in the middle of the square. And when you're in Rome, if you go to see the Pantheon, what you're actually looking at is one of the oldest and best preserved buildings on earth for its age. It really is just this amazing building. And we went into it. I had learned about it as a student of architecture. Went into it, had a look around, and the history is just insane. When you're standing in the line to get into the place and you're looking at these huge Roman columns holding up the temple. And you can see all these chips taken out of them. And those chips took place, hundreds, if not thousands of years ago when there was battles being fought and stuff like that. So you're standing there in history. And just to give you a bit of context, those of you who travel around Ireland and you will be familiar with the round towers that you see in these monastic sites. And I'm familiar with the nearest one to me here would be Glendalough. And Glendalough has this amazing round tower. When you're standing there, you're standing amongst the ruins. It's usually in a cemetery kind of place. And you're looking at a building that's standing for about 800 years. And that is an amazing, thing to see a building still standing up 800 years later. The Pantheon in Rome is 1,899 years old. It has been sitting there in Rome for 19 centuries. And it's just, it's in immaculate condition on the inside. The outside, as I mentioned, there's various signs of damage, but it's still standing and it has gone through the most amazing life. It actually, when it was built, it had this huge roof covered in, I think it was bronze, and it had this amazing sort of shiny roof. And then over the years, it was raided. People were kind of taking off the brass and stuff, and they used the bronze, I should say. They used the bronze to actually build the cathedral, some of the cathedral for St. Peter's. And so it's amazing. And I just find that super, super interesting. And if you're able to watch this video that I'm recording now, obviously those of you listening on the podcast, you won't have the benefit of it. But if you're actually watching the YouTube video version of this, I'm actually going to put up some of the photos and videos that I took while I was at the Pantheon, because it is really amazing. When you step inside the building, there's this incredibly, big domed roof with a huge hole in the middle called the oculus. And that was built 1,900 years ago. And what happened was that building stood there for about 350 years until the fall of the Roman Empire. So it was already a 350-year-old building at the fall of the Roman Empire. And when the Roman Empire fell, it was the beginning of what we call the Dark Ages. And the Dark Ages was effectively when civilization collapsed. The Roman Empire had been this age of, science and mathematics and, all of these skills and techniques. And they were able to build these arches, these aqueducts. They were able to build all this incredible architecture. And then in the Dark Ages, all of that knowledge was lost. It was not written down. It was not preserved. It was burned. It was like all of that stuff. And so 1,000 years later, there were people standing inside the Pantheon, staring up at the roof, at the ceiling, at this domed ceiling, and scratching their heads and just wondering, how did they do it? Like, how is it possible to build, where the roof comes out over your head and there's nothing holding it up? There's no support columns. So it took 1,000 years, another 10 centuries, before another architect or engineer attempted to do anything like the Pantheon. So it stood there for 1,000 years before they attempted to build another dome. So what is the point of this? I mean, this is not an architectural digest episode. This is, Gavin, why am I rambling on about Rome? Well, I'll tell you why. It's the whole concept of time and longevity. And that really struck home when I was standing there looking at this stuff that was centuries old, like 19 centuries. Try to get your head around the amount of battles, the amount of generations of people. Like there's maybe 4 or 5 generations per century. And this has been around for 19 centuries. So literally hundreds of great-great-great-grandparents like would have born and died in that time. And it's just incredible. And the reason I want to bring it up is just because time itself is one of the most underrated and powerful factors when you are an investor. And the understanding how to leverage time can be the difference between achieving financial freedom and having a life of missed opportunity. And I'm going to list out some of the reasons why I mention time. And I'm going to start with the concept of compounding. So Albert Einstein is famous for describing compound interest as the 8th wonder of the world. And it's really, it's kind of, lighthearted the way he said that, but the power of compounding cannot be overstated. If you put, let's say, people nowadays, we talk about 8% of a 8% return in your stock market account, or if you're trying to kind of invest on a regular basis or whatever. If you put 10,000 euro or dollars or pounds, if you put 10 grand into a deposit account that was paying you 8% per annum, you would have, at the end of 30 years, you would have 100,000 sitting in that account without ever adding another cent to that pile. So just 10 grand turns into 100 grand over a period of 30 years, and you don't have to add anything to it. Now, if you had decided to hold off starting the process, and if you had said, you know what, I'm not going to put the 10 grand away yet, and you spend just 10 years not doing anything, and then you decide, okay, I better go and put the 10 grand aside. The 20 years, you will only have 46,000 in that bank account after 20 years. 100,000 comes after the 30 years. And the growth all happens at the latter stages when it comes to compounding. And so the takeaway is really, the earlier you begin this journey, the earlier you start investing, the more you're going to benefit from that compounding effect when it comes to building your wealth. Those people who delay it and decide, I'm not going to take action right now, now's not a great time. It's, maybe I'll wait until the kids are a little bit older, or maybe I'll wait until whatever it might be. There's plenty of easy to accept excuses, but that's what they are. They're excuses. And I'm not casting, sort of judgment when I say that. I've been in that situation where it's tight as well, and it's not easy to kind of make the decision to go and put money aside. But when you do decide to do that, the earlier, the better. And if you prolong that decision, then, ultimately it's that compounding that will suffer. You won't have the time at it that you would want. The second thing that I'm going to bring up is something that's referred to as the 10-year wealth rule. And it was what most experienced investors will tell you, is that you never make money trying to time your entry into the market. You almost always make money by simply being in the market. And so it's not timing the market, but it's time in the market. And when it comes to property, a great rule of thumb is that your property asset will most likely double in value about every 10 to 15 years. That's kind of an average. You can obviously do much, much faster than that. And if you buy in the wrong location, it'll take much, much slower than that. But, location dependent, condition dependent, all of that kind of stuff, the asset you're investing in is capable of doubling, we'll say, over, say, a 10-year period. And I know, to give you one example of one of my earliest investments, the first property I bought was a small mews house, and I paid, as I can recall, £85,000 for it, and that was back in 1993, and I sold that property like 93, probably about 22 years later, and I sold it for $750,000. So your 85,000 became 750,000 over that 22-year period, like almost a 10x return. There was also periods when I invested in commercial property, and in that case, we were looking at more than doubling it in the space of a year. And in that case, you can kind of force that appreciation if you're able to find the right levers to pull. But generally speaking, if you don't want to be greedy about it, if you don't want to kind of go off after potentially risky deals, just simply holding a property for 10 years will typically outperform the investor who attempts to get in and flip something and, kind of keep on turning his money over and over. Just simply holding on to it for years tends to outperform. And a good example of that would actually be, I've just noticed today, a friend of mine pointed out that Sherry Fitzgerald is currently selling a property that I sold during the worst of the crash. I bought this property, beautiful property, really, really happy with it. And then the crash came along. I got myself into trouble, and the bank forced me to sell this property. And it was a beautiful, beautiful family home right in the middle of Carrickmines. They forced me to sell it. And I can't remember the exact price, but I think I sold it in the ballpark of about 700,000, 750. It's currently on the market at 2.65. So that guy, whoever he is or she, they bought that property from me at a very low point in my life, and they're now looking at making 2 million profit on that property. So it just shows you that. Now, in that case, obviously timing was part of it, but the fact that the person had the money, was in a position to buy and just hold for 10, 15 years, look at the profit that they're looking at now. So it just shows you what is possible if you just have the patience and the ability to stand there and take your time and not be under pressure. Now, there's another thing called the rule of 72. And this is a very simple way to calculate how long it will take for you to double your money, or in other words, to get your money back. And so if you simply look at something and divide it by 72. So let's say, to take an example, you're looking at a property and it's returning 6% return on investment or yield per annum. If you divide 72 by that 6, you will get 12. And 12 is the number of years it will take for you to double your money, no matter what price you pay at that yield. And so if you manage to find a property that is returning you 10%, then instead of taking 12 years, you will actually be looking at getting your money back in 7.2 years in that case. So you just simply divide 72 by 10 and you get 7.2 years. And this is why, A, being able to calculate the yield, but B, going after and having the discipline to look for the high yielding properties. The higher the yield, the quicker you're going to get a return on your money. And if you look at some of the clients in my group, one in particular has done very well, and he found a property and he's getting 19% yield on it, gross yield. And so 72 divided by 19, you get 3.7. That person will have all of his money back in his bank account in under 4 years. So that just gives you an example of what is out there, what is possible. And I know a lot of people are unaware of just the impact that yield can have. And they're kind of saying, oh, I'm looking in the Dublin area and I'm looking at something that's throwing off 7% or 8%. That's all great. 8% is not bad in the Dublin area. But if you were to look slightly further afield, you might be able to get 18%. So it's worth just being aware of this. Now, I used the number 18 there, and that is one of my next points. And this is something that is worth talking about. But the first time I ever heard this concept, I immediately dismissed it as kind of ridiculous. It's called the 18-year real estate cycle. And the theory goes, and it is a theory, but it's one that I'm looking at now, and it starts to make a little bit of sense. But you have to kind of take the certain theories with a pinch of salt. So the theory goes that it takes about 7 years for a property market to recover from the previous crash. And then when it's recovered, it takes another 7 years of growth, and then what becomes rapid growth, and then what becomes sort of overvalued properties, and a bit of a bubble starts to form. And so that's 14 years. And then what happens is the crash comes along. And when the crash comes, it usually takes a period of about 4 years from the start of the crash to the point where people are capitulating and deciding to throw in the towel. I can't take this anymore. I'm just going to let the bank take the property, or whatever it might be. And that 7 years plus 7 years plus 4 years is 18. And when I heard that first concept, I sort of said, come off it. Think about all the things that have to, be perfectly aligned for a recession to take place. There's geopolitical pressures, there's the economic pressures, there's interest rates, there's all of these things. All of these are factors that filter into this. So I don't want to believe that it's possible that every 18 years, you can set your watch by some sort of recessionary thing. But when I actually looked at these numbers and I went backwards, it is quite interesting, because if I go to 2008 and I look at the numbers in that way, so 2008 was the beginning of the crash, and it lasted about 4 years. So from 2008 to 2012, that's when all of the market was on the floor. And then it started to recover, but it didn't recover instantly. And so from 2012 to 2019, the market saw a 7-year upward recovery. But then in 2019, that's when a lot of people started to say the market's got too pricey, it's a little bit too expensive now. And it has been going up like that since 2019. And here we are. If you add the 7 years to 2019, we're looking at 2026 as the start of what they're referring to as this potential next crash. And the suggestion is that the crash will start next year and it'll go on to 2030. And then you'll have the next 7 years of growth and stuff. Now, it sounds plausible to a degree, because if you think about, we are a lot of people that are in my group, a lot of people in the mastermind, a lot of people are all saying, Gavin, I just can't find value. It's just madness out there. Everyone is all struggling. Everyone is bidding on properties and they're just overpaying for it. And so it was certainly an element of truth to the idea that there is potentially a crash coming on the basis that people have just been overpaying for too long. And then you also start looking at what's happening in the wider the wider economy. You've got Donald Trump in America talking about tariffs and talking about now potentially triggering a recession. You've got this constant complaint about house prices, and the cost of building has gone so expensive that it's kind of untenable for a lot of people to get stuff done. So all of that would point to 2026 being potentially a year when it all comes crashing down. If we were to go back in time and apply this same rule, it's quite interesting because it would suggest that the last crash prior to 2008 was 1990. And if you think about it, 1990 was the period when there was the currency crisis in the UK, and it drove up interest rates to the stratosphere. I remember it was like 17, 18% for interest rates, and that brought about this widespread crash in the market. And around 94, this is the year that I was getting out of, the year that my dad died in 93, 94, 95, 96, I was finishing my degree in college. And those were the years when there was a really marked increase in property prices. Things started to double in value, and all of this stuff went on. And that went on to about 2001. And in 2001, then there was this sudden explosion, and everyone was making so much money. And it was around about the time that the euro came in and the Eurozone, and suddenly interest rates in Ireland dropped from where they were at like 7 or 8%. They dropped down to 1 or 2% because we were now part of the euro. And so that fueled this incredible boom from 2001 to 2008, and then the crash. 2008 hit. And so sure enough, if you look at it like that, this 18-year cycle, it certainly works for the last 36 years. So when I saw that, I kind of thought, that is interesting. But again, you have to look at this and you have to question, what about all these factors? What about the amount of people coming to the country that can't find a home? The demand that's out there, the shortage of supply, government policy, if they're bringing in tax breaks, all this kind of stuff. So I'm not so sure you can squeeze it into 18 years exactly, but perhaps it's something to consider. And so that's one of the reasons why I wanted to make it. But you do, I wanted to mention it, but you do have to think about like COVID-19. That was an out of the blue black swan event. The terror attacks that took place in September 11th, 2001. None of this was part of any kind of economic plan or anything like that. So these were random events that shook the market dramatically. And so, you know, those were completely random. Or I guess there would be conspiracy theorists out there who'd say, or were they? You know, were they entirely random? All right, so let's get to the final point in this discussion, and it is the one good deal per year strategy. And as the name suggests, this strategy really focuses on just being really, really disciplined and focusing on finding one good deal every year that is exceptional, rather than chasing multiple, average deals and spreading yourself thin across them all. One good deal can outperform an entire portfolio. And this is quite true. And certainly when I look back on those outliers that I enjoyed, there was one deal and it made, 3 million in the space, or it made a 2.5 million profit in the space of about 6 weeks, 8 weeks. And so that was an absolutely exceptional deal. And if I only just did that one deal in a year, I'd be doing great. I did another deal and it was a really good one. And then there was other deals that I went after that probably, if I had just never gone after those deals, I would have done better. Some of them turned into loss makers and things like that. So just focusing your energy on the one exceptional deal. Now, it's not easy to do that because you don't always know which deal is going to be the exceptional one. But generally speaking, you do have an idea. It's important to point out that the this is how the venture capital sort of venture model works. You can have a look at these VCs that go and invest in startups and tech startups and stuff, and they invest in dozens and dozens of startups, and they'll throw, if you look at some of these big guys that invested in Facebook in the early days and stuff, those guys would throw $1 million into a startup, and they'd throw $1 million into another startup, and they might spread $1 million around 100 companies. And you kind of they assume that maybe 50 of them are going to go to zero. So they'll have lost 50 million there. And then 45 of them are going to probably just, get them back their money. And then there will be 4 or 5 out of 100 that return something like a 10,000x return. And so by just focusing on spraying across lots and lots of deals in that situation, they managed to bring in just the handful of deals that massively outperforms everything else and covers all of your losses. Now, that's all fine when you have a big fund, and it's fine when you're dealing with startup tech companies that have the ability to have like a 10,000-fold return. But when you're looking for property, there's no 10,000 return. You might be able to get a 2x return or a 3x return. And that's where you've got to be really selective. You've got to go after those deals, see if you can find them. And sometimes it can take a lot of effort. I know I had a call this evening with my mastermind group, and one of the guys sold a property some time back, and he's sitting on cash. And I can sense just a little bit of a sense of pressure that, I should be doing something with that cash. And I was just reassuring him like that, just stay focused, discipline, and just look for the extraordinary deal that will come across your desk at some stage, and you go after that one, and don't feel this pressure to spend the money on an average deal just to kind of get going in the market again. So time spent investing, if you would leverage it to your benefit, it can be massively beneficial. Now, what else have I got for you on time? And it's important, just my own personal insights on this. As I approach my 53rd birthday, I can tell you that time is this really strange paradox, because depending on what you're doing and where you are in life and stuff, time can go very, very quickly, or it can go very, very slowly. And if you're doing something that you really enjoy, you'll find that the time is gone in no time. And you're kind of like, God, I can't believe I just spent 2 or 3 hours doing that. Whereas if you're, let's say you're studying or something like that, and you're trying to study for your leaving cert or whatever, 2 or 3 hours can feel like forever if you don't enjoy the topic that you're studying. So it's all very, very relative to what it is you enjoy, and that perspective comes into it. You can imagine that somebody who is in their 20s and they're looking at the rest of their life, and they're thinking, I'm only 20, like I've got 50 years until I'm 70 years of age. Like that's an eternity in the eyes. But when you hit 50 years of age, like I've only got 20 years now until I'm 70 years of age. Suddenly there's sort of time is passing way too quickly for me. And there's this urgency in my mind with everything that I do. That urgency does not exist for 20-year-olds. And so you have to, if you're listening to this and you're a young guy, I think it's worth your while to kind of bring that kind of urgency and the importance to make these important decisions when you're young. Leverage your time and use all of these, if you're trying to build financial freedom and stuff like that, get started young. Take some of those sacrifices. Maybe you're not able to go out every night of the week. Maybe you can only go out one night of the week because you're saving up some money for your deposit or whatever. I would encourage you to do that. The other thing I'll say, and this comes because I had dinner with my family just a couple of days ago, and my oldest 3 daughters came over, and they're now grown up. So my eldest is 20, and then there's my 18-year-old, and then there's a 16-year-old. And those guys, like, I can scarcely believe that they are now the age that they are, because those 20 years, 18 years, and 16, they have flown by so incredibly quickly. And I'm sitting there thinking to myself, my goodness, here I am having dinner with my 20-year-old daughter. And I can remember like the day she was born, like it was yesterday. And so time really does go by far quicker than you will ever imagine, until the time is gone. You've lost those 20 years, and now you're looking at it and going, where did that go? So really, if it's the real takeaway here today is make sure you're leveraging your time. Make sure you're making the most of it. And it can go so quickly, it's frightening. Make sure that you're fully present in life, and try to avoid scrolling your best years on this mindless BS that might be on your phone or whatever. It's really important that, try to identify those people, those activities, and those achievements in your life that are of the highest importance and priority to you, and then invest your time in going after them and being present with those people. And you never know what you might leave behind as a legacy that maybe will stand the test of time, like the Pantheon has. That could be your family tree. That could be simply your ideas. You might write something down on a piece of paper, and hundreds of years from now, they're still referring to it. Or it might be something that you built, like a house or a property or something like that. And it just happens to be that you brought some sort of technique to it that's unique, and it's still standing hundreds of years from now. Who knows? Guys, hope you have a great week. I will see you in the next one. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it useful in any way, could I please ask you to take a moment to leave a review over on iTunes or Spotify or wherever you listen to podcasts. There is no algorithm for the podcast, and so the only way we can get other people to find out about it is when it's shared by you. So if you can do that, it'd be great. If you have any questions or topics you'd like me to cover on future episodes, please connect with me via the school community, or just send me a message on Instagram or wherever. You'll see the links in the show notes below. You can stay up to date with all of my content and the projects that I'm working on by signing up for my weekly newsletter, and you'll find a link below in the show notes for that too. That's all for now, guys. I'll see you back here same time next week.